Hi and welcome to our podcast today on how to buy and sell your business and thinking about funding in the context of buying or selling your business. Today we'll be going through it from buying and selling context thanks to Flippa, and I'm joined by CEO of Flippa, Blake. You're very welcome, Blake.
Thank you very much, Ciaran. Awesome to be here.
Great to have you. And I'll be kind of going through anything from a funding perspective. I'm the co-founder of Swoop, and we'll be considering all types of financing when it comes to buying and selling your business. So why don't we kick things off with just a bit of a general overview on things. First things first, it'd be great just to hear a little bit more about Flippa, just to set the context there.
Yeah, for those Swoop users who have logged in, and welcome to the Flippa community as well. Flippa is a marketplace and platform to buy and sell subscale online businesses and digital assets. So think about a Shopify e-commerce business, an Amazon FBA, an iOS or Android app, a SaaS app or Chrome extension, Slack plugin, those types of things. They can all be traded on our platform, and we have just in excess of 1.95 million buyers registered with the platform, and we see just in excess of 10,000 transactions a year.
Amazing. So definitely the right person to be chatting to in terms of listing your business when it comes to kind of anything e-commerce, SaaS, Amazon FBA. So I suppose digging into that for a second, have you kind of noticed much changing in the landscape in terms of the types of businesses that are coming on, or are you seeing a kind of healthy spread of all sorts of online businesses within Flippa?
Yeah, so we've seen an evolution. I will admit that e-commerce is still the number one traded asset type on Flippa. It did go through somewhat of a downturn, maybe mid-22, as there looked to be a tightening of capital availability, a trading down of customers with high inflation, etc. And so that has made trading conditions a little bit tougher for e-commerce, but it's still the number one traded asset on the platform. We've seen new categories pop up as investors who are quite savvy look to find that new asset that can take them on their acquisition journey and perhaps get them an ROI at a little quicker rate. And so that includes things like YouTube channels, which is very interesting, as well as, of course, the evolution of SaaS, but where SaaS is then utilized. So as I mentioned at the top of the chat, Chrome extensions, Slack plugins, those types of SaaS assets have become a little hotter. And then as it relates to funding, which is why I'm super excited to talk to you about, we've seen far more buyers interested in acquisition finance, finding pathways to capital, which will enable them to either buy a bigger deal or at least complement something else they already have with some more smaller deals. So it continues to change, but the reality is the platform economy is not going anywhere. There's more digital assets than ever before.
Absolutely.
And as a result of that, there's more savvy buyers who are capitalising on this particular space.
One thing I should have said before we started, please feel free to use the chat box to type in any questions and answers. I know we've had a huge amount of registrations for this. I think we've tapped out our Zoom link for the first time ever. So please feel free to share any questions. If we don't get to them, don't worry, we'll follow up with a blog and an FAQ afterwards to cover absolutely every one of them. But just digging in one little bit more, just an overview context in terms of Flippa and the type of customers you're seeing there. From the context of the businesses that are selling, what is the kind of the general thing you're seeing in terms of the size of the transactions, the kind of timelines associated with those transactions? What would be kind of typical?
Great question. So we're obviously talking about a good amount of money. And so 5, 6 and 7 figure transactions are where Flippa spends the most of its energy and where the buyers find the asset types at the sizes they want. And so the time it takes to get a deal done does differ greatly between 5 and 7 figure, as you could probably expect. One, you've got a great deal of competitive tension down at the 5 figure mark. And as a result of that tension drives speed. The other thing about that is, as you and I would both appreciate, there's more capital availability at the 5 figure. It tends to be mostly cash, mostly all up front, and the due diligence process on a 5 figure deal is relatively simple compared to what you might do at 7 figure landscape. Now at a 7 figure deal, you're talking about average 6-month sales cycles. And there's a reason for that. One, you're talking about a large sum of money. 2, the due diligence process on that is more involved. 3, you're often not talking about cash buyers,
Mm-hmm.
you're talking about buyers who have gone and found funding through a multitude of sources. In
Thank
some
you,
case, friends and family. In other case, our Swoop finance relationship, and in some cases, other debt capital facilitation or facilities. So it does vary a lot. Clearly, where a business is got fantastic operating and trading history,
Yep.
where they are showing great evidence of continued growth, typically measured on trailing 12-month growth,
Mm-hmm.
where their metrics, and of course the metrics that matter are different by business model, but where the metrics stack up against the peer set and the benchmarks,
Yeah.
i.e., sub 7% churn for a SaaS business, very low refund rates for an e-commerce with a high AOV, call it in excess of say $75 AOV and more. Those businesses will trade a bit quicker, but the short answer to your question is 180 to a 220-day sales cycle for a 7-figure asset.
Yeah. And then you mentioned in the 5-figure assets, it's super competitive in terms of you might have multiple buyers. So if you're on the sell side in a 5-figure scenario, what would you expect to be running in terms of potential interested parties within Flippa in that category? And then
A lot.
Okay. How does one manage that?
Yeah, so if you take, and I can only speak to it because I'm always sort of running one deal at any given time on a platform with 6,000 assets. So I'll talk about a particular asset that I'm looking after. It's a 7-figure asset, but it's top of mind, so I'll talk about that. We've had an excess of 21,000 individual buyers have a look at the asset, and that's translated to just in excess of 1,700 inquiries.
Oh my God.
So that's a lot. Now, the ultimate buyer for that asset turns out to be the CEO of a private equity-backed online toy retailer.
Okay.
And so, perfect buyer, good fit, given it's a baby and baby fashion asset.
Mm-hmm.
But that took us some time because that perfect buyer wasn't necessarily within the Flippa network to begin with. We had to wait for the matching to take over and bring that buyer into the Flippa ecosystem. And so, therefore, the timing takes a little bit longer. On a 5-figure deal, I'd say absolute minimum 500 inquiries, but up to in excess of 1,000.
Yeah. Okay. I suppose whether it's 5-figure, 6-figure, or 7-figure, or even 8-figure, how you set out your listing as a seller or put the opportunity out there, I'd imagine is pretty important. Kind of, what have you seen as like good behaviors or bad behaviors in terms of capturing the market from a selling point of view?
Yeah, that's a really good question because one, you can't sell a business without having a clean book of financials. You also can't sell it without being able to articulate the operational runnings of that business. Similarly, if you're on the buy side and you're looking to avail yourself of capital, it's unlikely you can get that capital if that business owner hasn't presented the financials in a way which is befitting what a lender would like to see. So what you need to do is you go through the Flippa onboarding experience and you'll connect some data.
Yeah.
That data is one of 15 different data integrations: Shopify, Amazon, QuickBooks Online, Xero, and a multitude of others. That will then bring data into the platform and enable us to expose that for you and to the prospective buyers. Those prospective buyers have signed an NDA before they get to see that data, at least in most cases. The next thing you'll want to do is talk about standard operating procedures. So what is the business? How does it run? As a result of how it runs, what is the revenue and then ultimate financial position of that business? And what we talk about in that context is adjusted net profit. So you take out, because they're small business owners, you'll take out things like entertainment, Uber taxis, and a few other discretionary items that don't make sense on a P&L as it relates to a buyer considering the deal. That will then get presented, and then a buyer will enter the deal room and start to ask questions about that deal. Hey, tell me about how you acquire a customer. If you advertise on Facebook, what is your cost of acquisition? Now, of course, as those questions come in, you should continue to update that listing to ensure that it's up to date as it relates to what buyers want to see.
Just digging into that one for a second, Blake, because I'm kind of curious, because given obviously the success of Flippa in that you've got such a massive buying community, but if you're putting yourself in the seller's shoes for a second, obviously you want to get a sale in as expedited way as possible. But you've got to, I'd imagine, be quite careful in terms of the stage gate of the information that you're releasing, given its sensitive nature.
Correct.
And also in terms of capturing buyers' intent and not wanting to spend any time with time wasters, and also thinking about it from I actually need to spend time running my business whilst also answering these questions. How do you guys think about that in terms of advising the stage gate of that information? And is there anything within the kind of the Flippa network that can kind of help those business owners in terms of kind of qualifying out any of that kind of buyer intent or questions?
Yeah, so I think once it gets beyond the non-disclosure agreement being signed by the buying party, the risk of information being disclosed to a buyer that a buyer can act on to somehow damage you or your business is actually, the risk of that is quite low.
Yeah.
So if you say that your cost of acquisition on Facebook is $50, that doesn't mean that suddenly as a function of knowing that I can execute to that level. If you say that you're in the baby fashion niche and you've got this fantastic supplier in China that hand stitches the names of children around the world on those jumpers before you sell them, that doesn't mean that I know how to find that supplier and then I know how to stitch those names on those jumpers. So it's interesting. We find a lot of small business owners are quite cautious with what they disclose. The reality is if you don't disclose enough, you don't get the buyer interest. And most of the time, the risk of disclosing something that somebody else can act on is actually very trivial. It's a little bit different where you have technology that is intellectual property that you're protecting, some kind of unique application for AI, or some kind of unique way of an outbound engine finding customers to bring to your platform, for instance. You might not want to disclose that. Now, ultimately, once a buyer submits an LOI, a letter of intent, that is either subject to financing or subject to a due diligence period, and they're typically 45 to 90-day due diligence periods, you will have to disclose a lot.
What kind of stuff will you have to disclose?
Certainly, you'll need to lift the lid on financials. So you'll need to provide zero access, QuickBooks Online access. Should you have audited financials from a bookkeeper and or accountant, you'll need to disclose that. Tax returns, you'll need to disclose that. And even standard operating procedures. So what does the warehouse look like? How are things stocked? What are your inventory levels? Which stock range produces the vast majority of your sales? If you've got a churn rate, what is the speed at which customers churn? What is your net retention? All of this stuff you're unlikely to get away with not disclosing if you're trying to collect a $50,000 exit or a $5 million exit. The reality is it's a lot of money for whoever's buying it.
I suppose digging into some of those terms you kind of touched on, like churn rates or cost of customer acquisition. So naturally, a lot of these businesses we're talking about are in the digital space, online, and so typically they wouldn't have there'd be asset light from a physical sense of the world. But obviously, both sellers and buyers are finding a sense of fair value, and people can gravitate towards revenue, or they can gravitate towards profit. But I imagine in the subsectors that you have, there are going to be some key scores that people are looking at when determining fair value. Are you able to kind of talk us through maybe some listings and showcasing where some of these metrics are and how they show them and how they drive in interest or attraction in the opportunity?
Yeah, absolutely. So the metrics that matter for each asset type are of course unique and different. And so a buyer who is interested in acquiring, say, an online publisher, which is, I guess better termed a blog, will be looking at free traffic. So what percentage of your traffic is derived through organic search, i.e. SEO, and what do those keywords look like? What is the competitiveness of those keywords? So do you have a moat around your demand generation? Now, if you do, that means that asset's likely to be a bit more passive than something that requires ad spend to acquire that same level customer base. And that's obviously very important for an investor because they then understand what their outgoings are likely to be as it relates to customer acquisition. Once they've then derived at an equation, i.e. great deal of free traffic, they're then going to look at the revenue and how the revenue is produced. Now, buyers are savvy, so it's a little bit different for each buyer. But for example, there was a particular asset that was called All About Cookies, and it was a GDPR compliance blog. And what they had figured out was that they were making $5 per page view, and 99% of the traffic was free traffic, i.e. organic.
Right.
Now, $5 per page view from AdSense is actually very good.
Yeah.
That was 2 ad slots per page, and those ad slots were generating $5 per page view. Really good, awesome, doing maybe $2.5 million top line, but like at a net profit margin of 97%. There's no acquisition cost.
Lovely.
1 employee.
Yeah.
Nice.
Lovely margins. Lovely.
Now, that's obviously atypical. You don't see that in SaaS, you don't see that in e-commerce, you don't see that in an Android or iOS or Android app, typically anyway. Okay, so the buyer's happy. Now, what is the buyer then going to assess to derive fair market value? They're going to assess whether they can do that more efficiently.
Mm-hmm.
In the acquirer's case, they had an ad sales team. So they were going to strip out AdSense. They didn't actually care about how it was making money today. They cared about the quantum and what the revenue per page view metric was. Once they'd figured that out, they said, okay, well, let's go and have a look at the other assets we already own. How effective is our own sales team at converting a page view to revenue greater than what this one is doing? They did that. They acquired it in excess of $5 million acquisition. They acquired that business. They stripped out AdSense within 24 hours and they started selling against the page views.
Amazing. One thing I kind of wanted to dig into in that both Flippa and Swoop have pretty global audiences, and I suppose for the purposes of today we're really talking about US, Canada, UK, Ireland, but in particular you see loads of transactions around the world, and I just wanted to know from the sell side, do you see any nuances in terms of speed, transaction size, subsectors by location?
Yeah, really good question. I mean, American buyers are more prolific on our platform than any other buying cohort.
And do you think that's just a psyche thing, or?
Yeah, I'm Australian. We tend to be
never got my Kiwi representation today.
Good colours. We tend to be a little more risk averse than the Americans.
Yeah,
most of us.
I think that's everyone in the world.
The other thing is availability to capital.
Yeah.
Okay, so Americans are quite content with the idea of taking on debt to pursue entrepreneurial endeavours.
Yeah.
And that's an awesome trait. And so not only are they willing to do that, the availability of capital is a bit greater, and there tends to be a better understanding for the digital economy in the US right now than elsewhere. Interestingly enough, though, here at Flippa, 67% of our deals are cross-border. So that's mostly, not all the time, but mostly an American buyer buying from an asset. Now, we see greater supply in Europe than anywhere else in the world.
Really?
So Europe's great supply, demand is predominantly American.
Interesting.
Now, I think that will continue to shift as the digital economy grows and as the buying universe around the world starts to become a little more, and I'm trying to say this in a nice way, but a little more mature as it relates to that risk aversion.
Yeah.
Last night here in London, we had 125 people turn up to a meetup, and they were predominantly buyers learning about the sector, showing interest. So I think it continues to expand and evolve. And that's part of the reason for the Swoop deal, actually, because we want buyers from all over the world. As you said, at the moment, this deal is limited to Ireland, the UK, Australia, and the US. But as it relates to the Swoop deal, we want more buyers to be able to access capital, to be able to buy these deals, more liquidity in the marketplace.
Yeah, and absolutely, I think from a macro trend, the supply capital is definitely getting more globalized, and those traditional barriers where particularly like larger financial institutions like banks, because of regulation and legislation, they are constrained to only put that capital into a specific geographic zone. But what we've seen is a huge proliferation of cash go into the private equity market. And a lot of that cash that's in the equity market but hasn't been expunged, and in both the private equity and the equity spaces, they're not necessarily constrained to traditional geographic barriers that banks or alternative financial institutions have, which means that there's a great opportunity for businesses, buyers and sellers to tap into this. And I think it's both our jobs as business owners to be able to connect that supply of traffic and capital. But I think the great news is there's an abundance of liquidity out there. But it's in the same way you're talking about how do I think about listing, how do I think about value. When you think about a financing side of things, it's evolved and it's matured, so you really need to be well prepared. But the good news is for anyone listening is there's fantastic liquidity and lots of good supply side out there.
Can we talk about that a little bit? So if I'm a buyer on Flippa and I'm utilising Swoop, what are the types of things that I need to understand about that process, the lending process? One, how long it takes. Two, the materials I need at my disposal, whether it's more about me or more about the asset that I'm looking to acquire.
Yeah, and I think there's some similarities in terms of how you were kind of explaining to me about whether it's a 5-figure, 7-figure or 8-figure transaction. What you'll find in terms of like a documentation preparation and a length of time of transaction will be very corresponding to in terms of what you need to prepare. That being said, even if you're going for a smaller transaction, it is always best to be prepared and have access to financial documents yesterday. So it's brilliant that Flippa and Swoop connect into things like your Xero, your QuickBooks, your Shopify, because hopefully then it just puts you in such much steady shape that you don't have to go trying to drag and analyze this information. But it is really important to start with yourself. So the person who is doing the buying, and to your kind of cultural point about Aussies and Americans, different nationalities have a sense of comfort talking about themselves. If I take my own nationality, Irish people don't tend to like to be as bravado as say the US. So when it comes to acquisition finance, they need to tap into their US psyche a little bit more.
Yeah, sell
themselves, because it's particularly if you're going for external financing, people need to buy into it. They need to understand it, and they understand why you've got the capability to not just acquire this business, but actually service the debt that you're going to bring it. So the starting point is going to be you and the people associated with you, and that's super important. So if you don't put the time and effort to explain yourself and your reasoning, you're going to fall on the first hurdle. The second stage is to also have those kind of key financial documents together. Again, it doesn't have to be War and Peace. Having a one-pager that can articulate the proposition, how it sits from your skill set, your team's skill set, and how you're going to execute on it. And beneath that, always have a 36-month financial forecast to hand that talks through a forecasted P&L, a balance sheet, and a cash flow model. Absolutely, there's assumptions in there. As we touched on, you're going to have certain information available to you at various different stages, which you can bring it in. But you absolutely will need that, whether it's a bank, alternative lender, equity or VC. One thing we were touching on earlier on about information and preparing information. One thing where we see people just get it completely wrong, particularly at a kind of a banking senior debt level, is, it seems a weird thing to say, but kind of shooting for the stars, unrealistic. These mad hockey stick things, like bankers actually would hate to see that. They just want to see realistic.
Different than venture capital.
Exactly, completely different. We want to see a story that makes sense, someone that understands the industry, someone who's going to add value, and someone that can service the debt. They're the key requirements, and you should be thinking about it in terms of the key documents. The key document is about you and your team, one pager, typical deck, and then have that 3-year forecasted model that goes alongside it.
So when you and I were talking this morning in preparation for today, even I was a little bit surprised about how much went into understanding the operational capability of the acquirer. And so can we just double click on that a little bit? So if I'm buying an e-commerce business because it's something I want to acquire, my financial capability to afford is clear and obvious for everyone to see. The underlying performance of the business that I would like to acquire is very good, but perhaps it's been growing 25% year on year for the last 3 years. I'm still going to need to present to the bank through Swoop my ability to run that through my own capability.
Yeah, for sure. And I think also sometimes people get very attracted to managing buy-ins, and they can be challenging from an external financing point of view if you don't have demonstrable skills in that business that you're acquiring, or at least not having someone within your team. So that's super important to show how you have worked in that industry before, or in terms of if you are maybe doing a bimbo, which is basically where you are bringing some of your management in yourself and keeping the management of the business that you're acquiring, and being able to show that actually through that structure, you're going to be able to bring the best of both worlds, where you're going to learn from management that's there, and also bringing kind of players in that they're going to be able to add those efficiencies that you were mentioning kind of earlier on in one of your acquisition examples. But absolutely, people are key to this. I think we were chatting this earlier on. Yes, there's obviously huge value in revenue and profit, but who were the people that drove that? So equally, in analysing the business from a financing point of view, it's equally really important to any underwriters or investment committees to understand who are the people going to be running it, and often they need to understand how involved those old business owners are. I think even we see a lot of acquisition financing being done on an unsecured basis, particularly on the UK side of things. We've seen a real increase in unsecured financing since the financial crisis in 2008. But what we've also seen over the last 2-3 years is the amount you can get. It's kind of going from kind of 250 to 500. Now you've got a large amount of players who are able to go up to 1 million at a fairly decent rate, starting kind of from 9%. But it is unsecured finance at the end of the day, and if you do want to use it for acquisition, that seller often will have to take a PG.
Yeah.
It's very unlikely that they're going to be able to do it. So often you're going to have to rethink what the instrument might be if you can't rely on those people. But I think you were making an interesting point earlier on, actually, outside of finance, understanding how those people can add value in the next 6, 12 or 18 months post-transaction can be really, really important in terms of getting a deal over the line.
Yep.
It's very useful from a financing point of view to understand how it works, but I also think for the success of the deal, is it fair to say that you really need to understand what role those people will play in the immediate post-transaction world?
Yeah, and that deal I was alluding to before, online toy retailer, publicly traded, buying a baby fashion business out of Australia. In that particular case, they are raising capital to do that deal. And of course, that is predicated on the existing business owners staying in the business for the next 18 months. So for those sellers and entrepreneurs listening in today who are thinking about exiting and thinking about how they might exit, it's often not as clean as take cash, walk out the door, go to the Bahamas, have a cocktail. It's often take some amount of capital up front and then subject to an earn-out, but then the capital that you received up front has probably been provided by a financing provider, bank, non-bank lender or somebody else, and then of course they are very intent on ensuring that the business remains at the level that it's been performing for the last 3 years, again into the next 12 or 18 months, and they'll therefore want the founders to stay on board. And
the financiers kind of want that too, because often when you're kind of structuring debt for acquisitions, okay, there might be immediate, I need to just buy this out, but actually sometimes what we'll see is founders are getting senior debt so they can go on a buy and build strategy. But the bank or lender want to get familiar with how they're going to encourage sellers to sell, but also how you're going to encourage sellers to stay in the business. So yes, I'll give you the senior debt and you can tap into the sum of money, but they want to understand how it's going to be serviced. So particularly when we see things like e-commerce or SaaS, they'll want to see how those payments are anchored into those average monthly sales, or how those payments anchored into a subscription fee. But equally, what they love to see is, okay, you're putting a level of growth expectations to your model. As we said, don't see a hockey stick. But you're putting in. So what are those motivators that you're going to kick in? Is it going to be great people you're going to hire in? Is it going to be people you're retaining? So how are you going to hit those kickers, which is going to be able to service our debt going forward? And that's about asking the existing founders what opportunities they see in the business, and where are their strengths and weaknesses today, because they're the things you can capitalise on to build that model. Can you talk us through the various financial instruments available to acquirers out there today? So you mentioned before an unsecured loan, and then you said PG. So that's a personal guarantee being provided by the entrepreneur that's exiting, which is highly unlikely that they're willing to do, because they'd prefer to go to the Bahamas and have that cocktail. But can you just talk us through the various financial instruments available to someone who wants to acquire a business via Swoop? Yeah, absolutely. The one thing I will say on the PG, the personal guarantee insurance, it's unique to the UK, but there is a very cool product in the UK called personal guarantee insurance. Okay. does what it says on the tin. But the thing to call out about it as a product, it can go up to the value of £400,000 sterling. So again, if you're in the kind of 6-figure transaction market and a PG does come into the equation and there is some kind of uncertainty around it, we have seen that as a great way to give comfort and kind of not be a blocker in a transaction. So it's a good one to consider. Okay. So yeah, let's walk through a few different options when it comes to acquisition financing and what you might want to consider. On one side, we're talking about unsecured. There's actually plethora options on the secured side of things. Now naturally that comes down to the comfort of the individual and how much they want to tap into their personal net worth. But certainly from a kind of a hard asset securitization point of view, whether that's tapping into property portfolios or commercial properties that either are used or vacant, all of these assets can be liquidated in inverted commas to raise cash against that can be utilized from an acquisition point of view. So that's something to kind of know off the table. But again, the potential buyer needs to be comfortable in that position. Then we get into things like say a management buyout. So that could be an existing team that are in a business and want to buy the owners of that business out, and often what they'll need, and this is fair to say in most financial instruments, whether it's bank-led alternative finance or anything like that, they want to see skin in the game. So what's skin in the game mean? Normally it means kind of 10 to 15% deposit of the amount that you're going, or if the person is putting up about 50% of their net worth, that's interesting because they're really putting kind of skin in the game. So that's kind of how we think about that. And I was kind of giving you an example of an MBO we had about a year and a half ago, and it's an interesting consideration, particularly for say our US friends that are listening. Often people use the SBA and the Small Business Association program to do acquisitions, and once the acquisition is bigger than $250,000, you must have an independent valuation done on the deal. That's not the case in Ireland or the UK, and this guy he'd a software SaaS business going for about 25 years, and it's kind of getting to the kind of near retirement age, and he'd kind of restructured his assets so that he'd move most of his shares into a business asset, so prepared himself for a sale, and kind of was working with the management team with this in mind, and they all kind of came together on a figure, and as they got closer to the transaction, the management team decided, don't think that's quite the right price, and it's like, let's get an independent valuation in. And what happened was the guy selling the business ended up his business valued about 4.5 times more than what he was willing to put up there.
After the professional valuation? After
the professional valuation. So what happened was they had to split the transaction across a two-year stage payment so that they'd be able to afford the transaction and pay it out. But I suppose that's an example of a management buyout. As I touched earlier on, you've got management buy-in, which is where you want to go, but we had a medical software one there recently where they had previous background in this profession and felt they could add a lot of value to a lot of these practices, as well as running this software into it. So in that case, that's where the management buy-in was successful. But I would say management buy-ins are much more harder to pull off than management buyouts.
And so what am I doing there? I'm basically putting the existing businesses, I'm using my existing business and my existing business capability as leverage.
Yeah, potentially there's a couple of different scenarios. You could be doing it from a business point of view. I just generally have a business in this similar space, and we want to go and buy this and stick some of our own team in there. Or alternatively, you could be a group of individuals that have certain skill set or capabilities and access to cash, and have confirmed access to liquidity from, say, a bank or a lender, in which you now want to go and deposit yourselves into that business and remove the kind of current management within it. You've traditional leverage buyouts, which is again, you've come up with a deposit, and the balance is coming from a bank or alternative finance provider who is giving you that capital to then get that acquisition. And then that acquisition might not be the full 100% day one, as we've touched on a few times on this webinar. It could be also in line with certain kind of milestone payments or things that need to be achieved before the full 100% is fully unlocked. And then what we'll see is kind of nuances in different countries where there are kind of programs set out to encourage financiers like banks or alternative finances to give capital out into the markets. And we definitely see that in the US, and we definitely see that in the UK. So the most popular one in the US is the SBA, or the Small Business Association, in which you can get access to acquisition finance using that scheme. And why that's interesting is 75% of that loan is guaranteed by the government. So it's really, really encouraging those institutions to get out there. Yeah. Anything that's government backed often does come with a little bit longer in terms of due diligence, filling in forms, going through the process. But that's not to be sniffed at if you get your acquisition at the end of the day. We've the same kind of in principle scheme in the UK, the Growth Guarantee Scheme. Again, it's guaranteed by the government. So it's encouraging banks and alternative finance providers to push cash out there, and that cash can be used for things like business acquisitions.
And to be clear, and without going on the sales pitch, if you're looking at a deal on Flippa, inside the deal room now, there is a financing tab. That's where the Swoop financing product is available, and people can then go through, and the SBA options are presented there if I'm American. The UK options, the equivalent options are presented there if I qualify.
Yeah, I was actually having a play around today. Saw today. It's very cool. And one thing I kind of noticed, which I think there's a lot of similarities, and we were only discussing it today as we were chatting earlier on, and it's probably worthwhile calling out when it comes to acquisition finance specifically, because like in Swoop, we'll do a lot of things like working capital. It's very straightforward. Give us your numbers. It's formulaic. Let's get you the cash as quickly as possible. But as we're kind of chatting here, there's so many nuances. There's considerations around how you assess value. Is time, like usually cheap money is longer time, more expensive money is quicker. So you've all those considerations. So as people come through and they see the banks or the lenders or the private equity that might be an option for them, we have a corporate fundraising team at Swoop that are there to listen and to hear all those different scenarios, so they can talk into which documents are needed, what is the process, so that they can kind of see, because where frustrations arise is where there isn't clarity on not knowing what's the process, what's the expectations, and that's very much where we're there. And I see a lot of similarities when I was also playing around today. If I'm listing my business, you guys obviously have the same with the broker service, where they're able to take a lot of that heavy lifting away from you and give you that level of clarity. And I think we've this a similar approach when it comes to acquisition funding, which is quite different from, say, your typical cash flow lending.
Well, at what point can I apply? So Flippa will enable you to submit an LOI. There's a modularized LOI builder there. Flippa will also enable you to submit an asset purchase agreement or stock purchase agreement. Stock purchase agreement being the same as a share purchase agreement. Do I have to have all of that complete and a deal in principle before I can apply? And what are your recommendations of the workflow?
Yeah, I suppose it depends on it, because you might be just looking to see how much cash can I get available, because you're like, I'm looking at multiple opportunities here, or I'm on a buy and build strategy. So you kind of need to know actually what level of cash can I get available to me.
So therefore it's more about my own capital position.
So in that case, you can go straight away and say, okay, right, like this is how much cash, or we can unlock this amount of senior debt. A bit like if you're buying your house, you know for a certain period of time this is going to be true. This is where the kind of rate,
house.
Exactly. This is kind of where the rates are at. So it does kind of depend on that side of things. But if you have a very specific transaction that you want to do, certainly to get anywhere near like a credit-backed offer, what you're going to be needing is both you yourself, your profile, but that combined set of financials in terms of what's actually happening in their business right now in terms of live management accounts, in the UK filed accounts, in the US tax returns, and the expected impact of your acquisition. Again, please flag, don't go stupid and put these hockey sticks in there. Be realistic. That's what they want to see. So again, if it's very specific on a transaction, you are going to have to work together on getting that kind of shared data set to get anything credit backed or credit worthy back from a financial institution or a bank.
What about timing? So I was speaking to one of our advisors over coffee this morning, and he said, they were expecting an answer from the bank on Tuesday, and that would enable them to then, move closer to close. And they didn't get the answer from the bank, therefore the entrepreneur's grumpy, and the acquirer's now still waiting for their answer. What are the expected timelines, once I've submitted this forecast, 3-year forecast? By the way, is it a cash flow forecast or is it a P&L?
So it's all three. So it's a cash flow statement, P&L, and a balance sheet forecast for 36 months. I would say. Naturally, if it's a smaller business, an early stage, maybe you might do 24. But I just think, in principle, it's best to do the 36. Again, probably frustrating not to give you like a dead clear answer. But again, it will depend on your bank, your alternative finance, who you're going to. But if it's on the 5-figure or the 6-figure, if we've got that documentation together, there's absolutely no reason why within I'd hate to say, like a week or even 10 days that you shouldn't be getting back real clear indication and intent. Either we're out of the game, let's just scrap this. We're very clear what the next steps are. As we get into those kind of 7-figure transactions, that's where we have multi-stage scenarios. But some are way worse than other. But every bank, they appreciate that this is getting frustration and this is the bone of contention. So what they try and do is get that early yes or no indication. And what our jobs again is to do on the corporate fundraising side is to give absolutely clarity of what this process is, like how many of these underwriting sessions, what is going to happen, how many investment committees need to be, that side of things. So I would say what you're seeing on the 5-figure to low 6-figure, you absolutely should be getting stuff back within a week. And in terms of closing that transaction out, again, obviously very dependent, but if all parties are interacting with each other, I gave you that example earlier on today where we had one turnaround in 7 weeks, even taking in Christmas and New Year's holidays. So that's the kind of 7 to 9 weeks, let's say, in that kind of 5 to 6-figure range. As we get into that 7, 8-figure range, this is when you're kind of more into your kind of, I would say, 15 to 20 week type range all in. Yeah,
and I reckon there might have been some jaw dropping because I don't think that people think it takes that long. They come in thinking it's a bit quicker than that. So I think that's a really important point that you've just made. Can we just quickly talk about, and sorry to put you on the spot on this, and we'll obviously should timestamp it. So what is it? It's sort of late into Jan. So I don't want to hold you to these rates, but what are we seeing out there? Because the world's changed a little bit since the Fed's dropped rates, at least at a bank rate level. So,
and I think this is a really good news story on this because whether it's the Fed, the Bank of England, European Central Bank, they've all had rate reductions over the last 12 months, and we have seen an impact in the market. Both at a bank level and alternative finance, rates are starting to come down. So we were chatting to this, and obviously there's a lot of nuance to it. But like if we talk about what are we talking about today in terms of Flippa-based companies, your SaaS, your digital, your e-commerce, they are looked at not as favorably as like asset-heavy businesses in terms of
which for me is weird, but I totally get it.
I'm not Mr. Barclays, but in their head, again, it's all, as I said to you earlier, it's good to be aware of the things that they are a bit wary of, and the bit they're aware of is that, this is a bit fatty, could it change? Like, where's the moat? You talked about the moat. If you could talk about your moat more and more, that gives them a bit more confidence. But because of that, I would say, in the Flippa business world, at a bank level, you're getting kind of prime plus maybe 3 to 4%. So prime, it obviously varies in markets where they're kind of UK, Europe, in around the kind of 4.5 type market, where you're a little bit higher in the US. So adding on kind of 3 to 4 points on top of that.
Yep.
If we talk about some of that alternative finance money, and what we've seen is really a reduction in that area, and we've even seen deals go as low as 9.5 this year, which we hadn't seen in a long time, like 18 months, and that will go into your kind of low to mid teens.
Yeah.
Your venture debt, which I suppose I actually never talked about this earlier on when you asked me.
Yeah, this would be great to hear about.
So some of the products, that's going to come in the mid-teens, even to high teens, which might seem punchy.
Can you define venture debt?
So the reason why it sounds punchy, and it absolutely is potentially, but if you can service it and work with it, it can be a really interesting product. So why is it interesting? Often the providers of this capital, venture debt companies or private equity companies, they're not restricted by geography. So you're a UK buyer wanting to buy a US company,
Yes.
you're a US buyer wanting to buy a Dutch company. They don't necessarily care where the geographic boundaries are. So great, okay, I've got a supplier of cash first and foremost. The other areas where the pros are is their adaptability and flexibility in terms of how that cash is collected. So what do I mean by that? Okay, so we talk about maybe charging you a mid-teens for the sum of money.
Yes.
But they understand you need to put cash to work in the business to get it up and running and get it into place. So they're buying into your vision, they're buying into you, they're buying into how the business works. So what are they doing from a financing point of view to make that easier? So they'll do maybe an interest-free period. So what does that mean? I'm not having to pay everything, all these capital sums on a monthly basis for a period of time, and so I'm amortizing out that interest payments. And what I'm also able to do potentially is add bullet payments. So I'm allowing for a build-up of excessive cash flow, growth in profit margins, so that in year 2, 3, 4, whatever it might be, I can make these bullet payments and manage that transaction. And that's why things like venture debt are becoming more and more popular instruments to use. But from a pricing rates point of view, they're always going to be more expensive than your bank and your alternative finance side of things.
And tend to be where you can demonstrate predictability. So if you've got 5 salespeople all generating $1 million in revenue, and you've done that consistently as you add new salespeople over the trailing 3-year period, venture debt can be a great resource if you say, well, look, I'm going to add another 5 salespeople.
Yes.
This is what they've done in the past, this is what we'll do in the future. You get that at interest-free terms, add that revenue in, and you can pay back that working capital.
Yes.
Or pay back that debt.
Yeah. And actually, just your point actually went on point, but when you said working capital, that also reminded me. Some people are like, oh, feck, have I maxed out here? What am I going to do from working capital perspective? But actually, you can find complementary products. So you need to service the acquisition and get that deal over the line, and you're like, ooh, sugar, I need maybe some working capital. So you can also think about the quote-unquote assets in the business. So we'll talk about e-commerce, your Shopify volumes, what's happening on a recurring basis. You can get revenue-based facilities alongside, or you can get invoice finance or selective invoice finance, and you can marry those products up to help you with your working capital requirements. So that's not going to impede you when you're thinking about the acquisition as well, and probably an interesting consideration that maybe not always people think about.
If you've got any questions, please do drop those in, and we'll take those in just a minute. So, in summary, obviously the financial underpinnings of the business I look at are very, very important. Typically, we're going to be looking at businesses which are established. You're not going to get funding for a business that's been around 6 months, 12 months, etc. You're looking for something more established. Yeah. And then, in addition to that, my own capability, either my assets at stake, or my bank balance, part of that those assets will be considered to be able to serve that debt. But then also, obviously, your capability and the team you're going to bring to the table will be taken into consideration. You're talking about 7-week processes, maybe
for a smaller transaction,
up to a 15 to 18 week process for a bigger 7 to 8 figure transaction. So there's a lot in that, and then there's these various instruments. We've got venture debt, SBA loans. We didn't talk about 401k rollover, but that's in the Swoop offering as well. Of course, the markets that we're currently servicing, and the fact that at Flippa you can now go and apply directly through the deal room itself Have we got some questions?
Yeah, we do. Sorry, we've obviously been yattering on for ages, and
Let's do it.
by the length of this list, we're going to do our best to try and get through these in
as many
15
as we
minutes. Probably should have been paying more attention. And as I said earlier on, if we don't get through these questions, we're going to do a whole summary wrap up.
We'll send long form answers too.
Exactly. Okay, let's go. So Adam Boscovich, can you touch on the insurance a bit? We are a buyer.
Reps and warranties insurance.
Yeah, do you want to dig into that?
Yeah. So, okay, let's talk about it generally and then specifically as it relates to Flippa. So, a lot of M&A transactions, obviously, all M&A transactions come with risk, and a lot of M&A transactions can be insured. So, generally speaking, what will happen is a buyer will take out reps and warranties insurance. That reps and warranties insurance will protect for false disclosure or non-disclosure. And actually, the entrepreneur themselves can protect themselves from non-disclosure, accidental non-disclosure through a reps and warranties insurance product. So it exists on both the buyer side and the sell side. At Flippa today, we have a partnership with CFC.
Okay.
They are the retailer of the insurance, and it's then brokered in the US by Rubicon, and it's underwritten by Lloyd's of London. Now, that is a reps and warranties insurance product, as I said, available on both the buyer and seller side, and you can buy that for approximately 1% of the enterprise value. Highly recommend doing it. 1% of the enterprise value is well worth it. Now, that is due to launch in the UK shortly.
Yeah.
So we will send everyone some information about that in the coming weeks. It's imminent. We're just waiting for compliance and governance on the assurer side to come through and sign that off. But very good option, highly recommend it. For US buyers, it's available in the deal room for any given asset that you are looking at.
Yeah, okay, awesome. Okay, well, I'm going to rattle through a few of these questions. I'm told we've got 5 minutes left.
Yeah, let's do it fast.
Right, next one I think is from me. Just want to find out if you want to start a new business, what help can I get it from Swoop? Okay, very quickly, depends on where you are. If in the UK, definitely look at the startup loan scheme, up to 25,000 per director, flat rate 6%, can be spread across 5 years. If in the US, absolutely look at the SBA program, can be used for acquisition as well. Let's go. I'm interested in buying. I would love to hear how the Swoop deal evaluates a transaction. Cash flow is more important than buyer statistics, and also interested to know in the insurance portion for possible fraud or bad sellers. Do you feel, just on that last bit on the insurance option, anything else to add from that last piece?
Not really.
No.
US availability, reps and warranties, 1% of the enterprise value, and pretty straightforward to get.
Yeah, and I think just in terms of the evaluation of the transaction from a cash flow perspective, what we're going to be looking at, I suppose what we'll initially look at, but what a bank or an underwriter is going to be looking at is the current MI within the business in terms of what are the profit margins. Absolutely, as Blake was alluding earlier on, you can make assumptions about taking certain things out from the current management accounts in terms of whether there's dividends being taken out of there or entertainment or expenses, but outside of that, looking how that business is operating, then layering in what you're bringing to the table. If you're adding debt in there, are you going to be able to service those repayments? You're obviously going to be putting assumptions in there in terms of expectations of what the business is going to be post the transaction, and if you're taking on debt. So how robust are those assumptions, and then from a cash flow statement, does it stack up like that? If you're going to hit these levers and these drivers, is it going to stack up?
Just on that platform dependency as well. So if you're going to buy an Amazon FBA business, therefore it's 100% dependent on Amazon, and Amazon has consistently and repeatedly put up their advertising rates, for instance, then the bank will take that into consideration.
We're absolutely not going to get through all of these.
We will send one forward.
I'm so sorry for not looking at these sooner. Do you have a solution for a US buyer acquiring an asset company currently formed and running in Australia?
Oh, wow. Yeah, I mean, cross-border transactions are difficult to fund, particularly Americans funding Australian businesses. The SBA loan scheme will not fund an Australian acquisition. What do you recommend?
Yeah, so this is where I think, as I was touching on the venture debt side of things, and again, you also need to put yourself in the shoes of venture debt. Why am I giving you venture debt? I fully believe you're going to make a significant boost to this business. So while I was kind of joking around about our hockey stick graphs, if you're venture debt, you definitely want to see a bit more growth than you would if you're analysing it from a bank perspective, or you're kind of on a buy and build strategy. So you want to be showing you're adding significant value, but venture debt will be where I'll be looking at.
Are the providers on Swoop? Can I go through Swoop?
Absolutely.
Yes.
Also kind of traditional PE as well, aren't restricted.
So go through Swoop and see the options for venture debt. That's great.
Yeah. Jordy C says, needing a down payment something that is typical for business acquisition loans? If so, what is the typical percentage for six-figure deals? Yes, I would say so. Earlier on, we're talking about kind of like at least around the 15% marker. I would say, as I said, or if okay, let's say brass tacks here, 100 grand, six figures. Yeah, you would need at least 15,000. If you didn't have it, no, I mean you would. But as I said earlier on, they'd also look and see about your net worth, and you're putting something considerable percentage in there.
Yeah, the no money down deal thing doesn't quite exist.
No, skin in the game is like if you want to leave with a lesson or a nugget, skin in the game is so important. And also, like I know actually. Shouldn't be asking you a question when there's a million here, but one point I wanted to ask here on is like you've got so many buyers trying to buy from these sellers. Surely the buyers need to stand out as well, so you need to be buyer ready, and one thing is some form of skin in the game.
Yeah.
Okay. Typically, how do LTVs look change based on different factors like perceived risk, strength, and background of purchasers? How high can so LTV, sorry, loan to value? How high can loan to value go? So yeah, this will completely nuance by country, by sector, by the individual, by the asset. So I think it is very hard, apologies, to answer this one like very specifically without knowing exactly kind of what the asset is and things like that. You'll absolutely, it'll be rarely you're going to see the 100% LTV stuff. Again, very similar to our deposit scenario. So I kind of remiss to throw percentage. 80. Yeah, percentage. I say 75, even something like that. I think I if you were to kind of fag packet rough model, I'd throw a 75 if you're trying to work some models together. Okay, do I have time for more, or am I just keep going?
I think wrap up with two minutes.
Two more.
One more question and then
one more question.
Closing outros.
Right. And we promise we'll come back to you all.
Yeah, okay. A quick one here from David Pope. Best way to approach sellers about seller financing?
Yeah, awesome question. Just ask the question up front.
Yeah.
So let's say for argument's sake, you're just talking about six-figure deal, $100,000. You're very unlikely to get away with 100% seller financing. Most commonly, deals done with seller financing will be 60% cash down and then 40% seller financing. So $60,000 in cash, 40% of that, $40,000 therefore seller financed. Typically 12 to 18 month terms, and we're seeing sort of negotiations around 7 to 10% interest.
As a percentage, like would you say seller financing in the most common, least common in terms of within transactions?
I am going to totally guess.
Yeah.
So this is not built around objective data, but I'm going to say 30% of deals will be done with a seller financing component.
Okay. And I'm going to leave you with an absolute humdinger of a question here, because there's oceans you can go to this, but I'm going to put this one to you. How do you know how to successfully run the business?
Whoa.
Or can you be a silent partner? Answer me that.
Yeah, okay. All right. So, one, write down a list of the things that you know how to do really well. And so if you know how to write content really well, if you're an outstanding salesperson, that's great. If you know how to negotiate deals, awesome. If you know how to write content, fantastic. If you know how to buy ads, wonderful. Write down the things that you know how to do, and then basically look at the business models where those things would be most relied upon or where there's a great dependency on. Then that will orientate to a particular business model. Don't buy SaaS if you've never run a technology company and understand what churn or LTV means. Just don't do it. After you've looked it up, it doesn't mean you know it. So orientate where you have a skill set. And then finally, once you've orientated where you have a skill set, orientate to where you have a passion, because businesses are hard. So not only do you want to apply your skills, but you want to apply your skills where you have outstanding passion.
Awesome. Can't think of a better way to wrap it up there. Thank you so much for listening. Sorry for not getting to the questions sooner. As mentioned a couple of times, we will put all questions in the follow-up. You'll be able to get access to the full webinar plus various cuts and an overview on flippa.com and on swoopfunding.com. Thanks again for tuning in and look forward to speaking again next time. Thanks so much, Blake.
Thank you.